Many of you, your New Year resolution is to start investing, but maybe as the beginner, you don't even know where to start because investing is such a complicated and difficult word, right? So in today's video, I'll introduce some of these investing strategies from low level to high level. So you see which level are you comfortable to take on, because ultimately investing depends on your personal risk appetite. How much risk are you willing to take? How much losses and gains are you comfortable to bear? Since I cannot speak for other people, I can only speak for myself. For my very own personal investment strategy, I'm more of a defensive person. I don't go for very high returns and very risky stocks. I try to go more of a minimalist approach. Like, I want to pluck all the low-hanging fruits first. Whichever is easy for me to accomplish and get the rewards at the best return at the shortest amount of time, I will achieve that first. Then I think about other things. So to some people, it may be considered a slow and steady return compared to a fast and aggressive growth with astronomical return. So if you're someone watching this video and you're much younger than me in your 20s and you see, I don't want to go for so slow and steady, I want to go fast, I want to go astronomical. Okay, this is not for me. You want to chase for high risk, high return and high growth, then that's for you. But I just want to tell you that I was once like you in my 20s chasing after all these shiny things, shiny objects. But I've grown to tone down a little and focus on things that really generate me more wealth than all these other flashy things. But before you even start investing, I think two things you need to clear is your high interest debts. Okay, let's say if you're taking on a personal loan, which is like 4 or 5% effective interest, you want to clear those things first, alright? Make sure that you don't have all these high interest loans or debts that are bothering you, because your investment return may not even beat that interest incurred for these loans. And secondly is to make sure that you have sufficient personal insurance in place. For example, you have an hospitalization plan, make sure your surgical and medical bills can be covered, and also any kind of personal accident in case you are not able to work. So you see, my approach is very defensive one, right? I make sure my bases are covered first. Then I go offensive on things that I can afford. But for those of you who are really starting out, you all really don't like to see loss one, must see capital preserve one, cannot bear to lose any money, then it's the first level, which is your Singapore savings bonds, your treasury bills and CPF. Because all these are guaranteed and protected and will not lose any capital because there's very little risk involved. For example, the Singapore savings bond is giving you close to 3% per annum return if you hold it over the period of 10 years. And you can use your cash or SRS to buy the Singapore savings bond. For T-bills, it's a short-term 6-month holding period, but you are guaranteed that cut-off yield, which is recently at 3.66%. And both the Singapore savings bonds and T-bills are government securities. So in terms of security and safe, they are the top tier already. Nothing can beat these two in terms of risk level because it's guaranteed by the government. Then for CPF, I've covered a lot of CPF content in my channel, so I'm an advocate to top up your CPF and contribute to the special account if you do not need so much in your ordinary account. It's because if you do not even hit that $60,000 in the combined CPF balances, you can get 1% additional interest, up to 20k in your OA and 60k in your combined CPF balances. So for those of you who don't even have 60k yet in combined CPF, maybe this is the first thing you can take on if you are that level 1 investor. But to be really fair, if you are at level 1, you are just starting out, you're not really like the real investor because you're buying capital secured stuff like even fixed deposits, which I did not even talk about because the return is so little right now. But if you want to join over 13,000 members interested in personal finance and discuss how to invest, then join us at Honey Money SG Telegram group today. Let's turn the level up a bit higher, which is level 2, money market funds. Now, money market funds has recently grown some popularity because their return is catching up. In fact, if you look at the most popular fund, which is Fullerton SGD Cash A Fund, which is giving around 3.7% per annum based on the last 7-day yield. And Fullerton SGD Cash Fund is a low volatility fund that benchmarks to Singapore dollar bank deposits rate. Now, don't be confused, even though it says it's a money market fund, it is not a cash deposit. And the risk level is very different because investments can be subjected to gains or losses, whereas cash deposits in savings account, they are guaranteed by the SDIC, right? Capital protected, but not for money market funds. The good thing about money market funds is that it is much more liquid compared to fixed deposits or T-bills, but likely the risk is also higher because sometimes you may get negative return on some money market funds. And that's just for the SGD cash fund. How about a USD cash fund? Because such USD cash funds can give above 5% per annum, but I don't really recommend them because for starting out as investors, you may want to avoid all these foreign currency fluctuations, complicated things altogether. Then the next question you might ask is, how do I even get started with money market funds? A few of the discount brokerages do offer them, and one such example is by Moomoo Singapore because they are giving you 6.8% guaranteed returns, and the sponsor of today's video. The Singapore GST just hiked 1% in 2024 and times are tougher now. But Moomoo SG is doing 1% more with idle cash because you can get 6.8% per annum with the new Moomoo Cash Plus promotion for 31 days. At a max subscription of $60,000, you will be getting a total return of $340. What's more, Moomoo SG now has the Fullerton SGD Liquidity Fund, which provides higher flexibility with same-day subscription and redemption for more opportunities. That's not all. You can get up to 4 stock bundles of the top 5 traded US stocks worth $70 each and 1 Apple stock worth $260. And if you sign up with my exclusive link, you can get 1 additional $20 cash coupon. Total rewards value of 900 Singapore dollars. Of course, holding period and buy trade applies. Please note that Moomoo Cash Plus is an investment product. It is not comparable and is different from savings deposits. Principal is not guaranteed and up to 31 days, 6.8% per annum is guaranteed only during the promotional period. Investment in capital market products involves risk and the risk of losing principal. For more details, please refer to the promotional page in the description below. So don't miss this deal and use my referral link down below or scan the QR code right here to get your Moomoo SG Universal account today. Alright, so we've covered level 2. Let's move on to level 3, and that is where index funds and ETFs come in. So index funds are also my most preferred way of investing in terms of the risk level because I don't have to pick specific stocks. I just want an ETF that tracks the index, especially the S&P 500 and whatever world indices, because I just want to benchmark to the market. I don't need to have astronomical returns. Just good to beat inflation is good enough. So if you are looking at Singapore markets, most commonly we have the STI ETF, which is ES3, which tracks the top few companies of the Singapore equities market. Then if you are particularly interested in REITs, then there are also REIT ETF like a CLR, Lion Philip S-REIT ETF. For the US market, if you want a US domicile ETF, then you can look at VOO, which tracks the S&P 500, very cheap expense ratio of 0.03%. Then for the NASDAQ, you can look at QQQ or QQQM. All these are index funds. But I know some of you are slightly more savvy. You will know of this kind of thing called Ireland domicile ETF. The difference between this Ireland domicile ETF versus US is that other than the lower withholding tax, there are also no estate duties should the beneficiary passes away. So that's why it's become more popular for people to invest in Ireland domicile ETFs that are listed in the London Stock Exchange. For example, if you want to invest in S&P 500, then the most popular ticker would have been CSPX. Then if you want to invest in the world index, you can look at ticker VWRA. And for developed markets only tracking the MSCI World Index, you can look at IWDA. So that's level 3 index funds investing for you. Now, what if you want to go even more advanced? You want to start picking stocks? Then I think you can start looking at level 4, which is dividend investing. And I think dividend investing is still quite popular because some people like to see cash flows coming in. Regular cash flows come every quarter, like passive income like that. For those of you who are new to dividends, it is a distribution of profits to the shareholders of the company, which means if you buy a share of this company and when the company wants to distribute the profits, they will pay you in the form of dividends as a form of reward. And dividends can either be paid out as cash or stock. So the default option, most people would pick cash over stock unless the stock is really priced really competitively. In Singapore, why dividend investing is really popular is because we don't have any kind of dividend income tax. Because Singapore practices a one-tier tax system where the corporate level is already taxed. So the company is already paying out their post-tax profits to the shareholders. Which is also why we have so many real estate investment trusts known as REITs, especially the Maple Tree REITs, the Capital REITs, and so the Frasers REITs. All these companies very popular. Your shopping malls, your commercial offices, your industrial buildings, in your business spaces. Or some of you like to invest in the top 3 Singapore banks as well, DBS, OCBC, UOB, because they give very regular dividends and they have enjoyed some profits over the years. But the thing about dividend investing is that you really have to pick the correct stock. Like some REITs, they really are blue back REITs, they are not blue chip REITs. Banks are still doing okay for now, but in the future, no one really knows because past performance is not an indicator of future performance. So depending on your risk level, these are the 4 levels of investing as a beginner you can look at to see which one suits your taste better. And you realize that I did not cover one specific segment, which is stock picking US stocks, because that involves a whole new different level of skills that you have to read through financials that beginner it would take some time. It is not a one-day thing that I can teach you. All the fundamental analysis, technical analysis is too difficult for beginners to comprehend. So you start with this 4 level first, and as you advance up the ladder, then you can look at where are the good stock picking skills. Remember, if you just want to open a trading platform, then consider Moomoo, because you can park some funds inside the money market funds and earn some idle cash returns as well. And if you want to check out how do I invest myself personally, then I can show you how I did it in my automated dollar cost average investment strategy video right here.